Let's move on now and talk about this risk management reading. This is risk management from 20,000 feet. So we're taking a very high level view here. No calculations, no Greek symbols that are coming to my mind, although we will talk about something represented by Greek symbols. And so I think the point here is to get the big picture of what we're trying to do. And overall, I would say the driving point here is to understand that risk management is not the same thing as risk elimination, right? So we want to manage risks, which means we want to accept those risks which we're good at managing and maybe eliminate some others and monitor risk going forward. But the organization that takes no risk also makes no money, right? So you've got to take risks in order to profit, whether that be operational risks or anything else. But you've got to, this risk management thing is not about avoiding or eliminating or minimizing risk. It's about optimizing the risk portfolio of the company. So the objectives of risk management, we're going to determine the organization's risk tolerance. And we'll spend some time talking about this. But basically, we've got to decide how much risk can this firm take, or is it willing to take? There's going to be inputs from a number of sources on this. We could have the regulators in place. We could have the shareholders. We could have restrictions in terms of covenants associated with our bonds. We could also have management preferences, which we would see manifest in a number of areas, in particular, well, not in particular, but including maybe the current asset structure. So some management teams keep a lot of cash around. Well, if you got lots of cash, you can deal with the short-term problems and overcome the risks associated with them. So risk tolerance is going to be important in determining for an organization. That is going to be done from the point of view of the entire organization. We want to identify and measure the organization's risks. So exactly what risks are we exposed to, and then modify if we don't like it, or at least monitor going forward. So we still have to take risks. We may be able to increase or decrease those optimally. We may decide to eliminate them or shift them to somebody else, but nonetheless, all of those things are going to be on the table. So again, this doesn't mean that we're trying to avoid or minimize risks, okay, but we're trying to optimize our risk portfolio by saying, here's the ones that we are good at accepting and good at managing, and here's the ones that we're not good at, and we'll either bring in expertise to get good at it or shift them to somebody else or avoid the activity that generates that risk, those types of things, all right? So the risk management framework in 7 easy parts. I don't think that this is a list that I would want to memorize all of for the exam, but nonetheless, we want to establish the risk governance policies and procedures. So we got to know how we're going, who's responsible, how we're going to go about identifying risks, how often we're going to review them, all that sort of stuff. As part of that, we're going to determine risk tolerance, as we just talked about. We've got to identify the risks that are out there, and once we identify them, we're going to measure them. What's our exposure? Actually, this is a really hard thing to do, measuring these risks, but we have a few tools we can use. We want to manage and or mitigate risks. We want to monitor the risks that we have continuing exposure to. We want to be able to communicate across the organization. So so if you talk to, well, doesn't matter who said it, but anyway, I was talking with the risk manager, and he said his job was just making sure that everybody wasn't on the same side of the boat, right? So you don't want everyone on the same side because then it tips over and capsizes. You wanted to have these risks spread out so they'd be offsetting, that type of thing. So you need to be able to communicate across the entire organization. And then strategic risk analysis, that is, let's think about if there are changes, how is the firm going to be impacted? Or is there some potential for really, really bad outcomes? Are we exposed to that? Do we think that's possible? How do we control it if we think it is potentially deadly? Those types of things. So risk governance. So once we've identified risks, we are going to govern those risks. So managing risk to support the organization's goals within its risk tolerance. So we're going to establish our risk tolerance. This is how much we can accept. Okay, and there's multiple ways to do that. We'll get to talk a little bit about it in a couple of minutes. Okay, but we're going to have some risk tolerance. But then within that tolerance, okay, we've got to decide, well, how are we going to allocate that across different activities or different asset classes or whatever it has to be done. And of course, this has to be an enterprise level and it has to be senior management. So there is going to be a risk management committee in most big firms, in all financial firms, but in most big firms, there will be a risk management committee. that identifies specific risks that should be pursued. This is what we want to do. This is what we're good at. Okay, those that should be limited. Okay, we can take some of this, but not a whole lot. And then there's also some that should be avoided. That's not in our power alley, and it's not our cup of tea. We're not going to take on risks in that particular domain. So risk tolerance and risk management again. So tolerance here, the overall level of risk exposure for an organization. Okay, the factors for determining risk tolerance are going to include our expertise in specific business lines. So if we are really good at credit analysis, then we may be in the business of taking credit risk, right? So that's just what we do. That's what a bank does, right? They accept credit risk, and their expertise in that specific line is high. However, their expertise, and let's think something other than the monster banks, but their expertise in understanding systematic risk could be very different, right? So we're going to determine where we have expertise, our ability to respond to external events. So, how do we respond if there's a crash, if there is some I guess what we call event risk, right? So there's something that happens that is going to have a potential impact on our company/portfolio. Our financial strength, that is, if we can't respond, we can't stop the bleeding. Do we have enough financial strength to withstand big blows? And then, of course, the regulatory environment. We've talked about life insurance companies. Well, life insurance companies, I think, would generally like to take more risk in their portfolio than what they do, but the regulators won't let them, so risk tolerance is going to be in part determined by the regulatory structure that is in place. So we're going to, and like everything in life, okay, it is a cost-benefit analysis. So we're going to take these risk exposures and we're going to trade them off against the expected benefits. So we're going to have benefits, and then we're going to have cost. The cost is the risk or the cost of minimizing a particular risk. It's a cost-benefit analysis like everything else in life. And where the benefits of accepting risk are greater than the costs of bearing it, then we will bear the risk, essentially. Risk budgeting, okay, so this is a little different. So we've already got some sort of overall organizational idea of risk or risk tolerance, but we need to allocate this desired amount of risk among all of our different assets or investments or activities, right? So the organization's goals and risk tolerance are going to be important here, okay? And the risk characteristics of our different activities or our different investments are going to be really important. Now, the trouble with this is, if you've got an idea of how much risk you can take, your risk tolerance, that can be specified a number of ways, all of which are difficult, and then taking that and dividing it up into separate asset classes or separate activity classes is going to be even more difficult, and trying to match those up between the activity and the way we've stated tolerance is going to be something that is difficult. Just because it's difficult doesn't mean we don't do it, but measuring risk is easier in some places than it is in others, but it always exists. So we could use single metric variables such as value at risk, okay? So we'll talk about what that means in just a moment if you don't know. We could talk about portfolio betas. We don't want our beta to be above 1 or 1.2 or whatever it happens to be. If we're managing fixed income securities, we could talk about the portfolio duration, which of course is directly linked to interest rate risk or interest rate sensitivity. So we could talk about these single metric things, but we could also talk about metrics that impact an entire organization. So we could talk about wanting to control interest rate risk, right? Well, interest rate risk is going to impact fixed income. It's going to impact equity. It's going to have an impact on our obligation under our derivative portfolio. Okay, it's also, if we're an operating firm, it's going to impact our coverage ratios and therefore our bond obligations and that type of thing. So we can identify risks in a number of dimensions, and we've got to think, okay, here's our tolerance. Okay, well, how do we slice and dice that? That's the idea of risk budgeting, right? So financial risks, okay, this could be credit risk. So we've got counterparties that might not fulfill their obligations. So think of a derivatives contract. Someone wins, someone loses. Well, if you happen to be on the winning side, if it's a financial forward contract, then is the counterparty actually going to be able to make good on their obligations? Liquidity risk, so this is the risk that we would need to sell assets at an inopportune time. So we would receive less than what we're going to call here their fair value. Never been comfortable with that term, but nonetheless, we are forced into a fire sale type environment. And then market risk. So again, that's uncertainty about asset prices, interest rates, those types of things across time. So all of this, of course, it makes lots of sense if you happen to be studying for the CFA. These are all financial risks and easy to apply to a portfolio environment or to a financial firm. There's also lots of non-financial risks. So operational risk, so human error, okay, or faulty processes. We see that when there is some sort of big cyanide gas leak somewhere, or when there is a rogue trader. Those are operational failings that end up bringing down companies or having really serious implications for the company. Solvency risk, so this is the risk of running out of cash, not being able to pay your bills, also having liabilities that are greater than your assets. Regulatory risk, this is the changes in regulation that impose costs. So we can think about the banking industry in the United States. Well, we went through a long period of increasing regulation. We deregulated for a while, and now we have increasing regulation again. Well, those impose costs, restrict activities, limit profitability, all that sort of stuff. Well, the risk of regulation changes that are going to impact our future cash flows, our future value is going to be regulatory risk. And then outside of changes in government regulation, there's all the other stuff that could happen in government, right? So political government tax risk, so changes in the tax code, all that type of thing would also be non-financial factors. Legal risk, of course, if you live in the United States, we are extraordinarily litigious. So, basically, if you look at somebody wrong, you get in a lawsuit. Model risk, this is the idea that we have incorrect asset valuations. So think of a hedge fund that has to report the value of the fund, and they've invested in assets that are thinly traded or non-traded for some reason. Well, they've got to use a model to come up with a value to report to the people, their investors. Okay, well, what about the model? Is the model right? Are the inputs correct? All that sort of stuff. Well, you've got model risk associated with that. Tail risk. Okay, so we talk a lot about tail risk, and some would identify risk management as really worrying about the tails, and what that refers to is the tails of the distribution, right? So a risk manager would say it this way: everybody else in the organization is concerned with what happens in the middle of the distribution. I'm concerned with what happens over here in the tails. So that's the underestimating the probability of an extreme outcome, in particular, extremely bad outcome for the firm, is tail risk. That these events are very rare, but when they do occur, they can be really costly, right? So, if you think of this in a distributional sense, well, if you incorrectly assume normality, okay, well, what if you have a leptokurtotic distribution where you have much fatter tails than the normal distribution? That means there's a lot more probability out in the tails. And if you're talking about the negative tail, well, if you're using normality, when in fact you have a leptokurtotic distribution or a negatively skewed distribution, you don't understand the full potential for these tail risk / extremely bad outcomes. You don't have a good handle on that. Accounting risk would take on two flavors. One, that you end up with people saying that's the wrong way to do it and get a lot of bad press. Also, that you do something that the accounting behind it requires that you report it, and it corrupts earnings or something along those lines. Measuring risk exposure. Okay, we can think of this in terms of standard deviation. We've done that before. Beta, so this would be a measure of systematic risk or duration. So all of that would apply pretty well when we're talking about a financial portfolio. It's a lot harder to apply when we think about the risk of being hacked, right? That we have some sort of nefarious activity associated with our databases and that type of thing. That's also part of risk management. So measuring that, your hackability score. Well, I wouldn't know anything about how to calculate it, although maybe I should work on that. It sounds like a good consulting business. Anyway, so risk assessment methods. Well, a couple of things we can do. Stress testing, of course, is a big deal. So you can think about the changes in a single variable. So if you're looking at a bank that does lots of real estate lending, Well, looking at stressing the value of real estate in their particular market, that would be a stress test. So what if the value of real estate falls by 10, 20, 30, 40, 50, 60%? And you can find out where it ruins the bank, right? So that would be stress testing. You could also, of course, do scenario analysis where you have lots of things changing together. That is, you've got the value of real estate falling and oil prices falling and interest rates increasing and, all these things happening together. So you're changing multiple variables there. And this is, you can take this and computerize it and do simulation analysis and come up with a whole distribution of potential outcomes. But scenario analysis just means you're changing a set of variables. Stress testing means you're changing one variable, all right? Okay, so what about measures of tail risk? I think this is two of the more testable elements in this particular reading. So I'd make sure to have a handle on the definition. We're not asked to calculate it here. But the VAR, or value at risk, so this is the minimum loss over a period with a specific probability. All right, minimum loss over a period with a specific probability. So, for instance, if we have a 1 month VAR of $1 million with 5%, okay, that's our assessment of risk. Then what that says is that in 5% of the months, we would have a loss of at least $1 million. It's the minimum loss, okay, that we're going to have with a 5% occurrence. So the 1 month VAR of $1 million, 5% probability, then over 20 months, okay, then we should see at least one of those where we have a $1 million loss. That would be our value at risk. Now we can take that and we can think, well, we could get farther out into the tails, okay, if we look at a conditional VAR, and that is the expected value of a loss given that we actually have the loss exceeding some amount. So what you can companion these things, say, okay, we have a 1 month VAR of $1 million, 5%. Okay, so 1 out of 20 months, we're going to have a loss of at least $1 million. The conditional VAR says in those months that we have a loss of $1 million or more, what is its expected value? So in those 1 in 20 months where the losses are big, well, what is the expectation? Conditioned on being in that bottom tail of the distribution, what is the expectation for the loss there? So maybe that is a conditional VAR, okay, of $6 million, or just as a number. So that says that when we have losses that exceed 1 million, okay, and that's going to happen with 5% probability, we would expect the loss to be equal to 6 million, which that'd be a big difference. But nonetheless, that's what it's telling us. So VAR and conditional VAR. Okay, measuring risk exposure for derivatives. So we get to review this in the derivatives material, but these are, of course, the Greek risks, right? So delta is the sensitivity of the value of the option to the price of the underlying asset. So if we're talking about a call option, if the price of the underlying asset goes up, then the value of the call goes up as well, right? The specifics of it I'll leave to the derivatives material. So for those of you who are good with calculus, this is just the first derivative of the Black-Scholes with respect to S, the value of the security. So the first derivative of Black-Scholes just says when we change this value of the spot price of the asset, how does the value of the derivative change? That's delta. There's no calculus on the exam. I just add that as a way of thinking about it because it's easy to explain gamma. If you think about delta as the first derivative with respect to S, then gamma is the second derivative with respect to S. So it's a sensitivity of the delta to the price of the underlying asset. So if the delta tells us how the option changes when the underlying asset price changes, gamma tells us how the value of delta changes when the underlying asset changes. So this is going to be a first derivative, and this is going to be a second derivative. Vega is the sensitivity of the option. Let's think of it that way. So it says derivative, but option, to the volatility of the underlying asset. So remember, these derivatives, at least options, are volatility plays. So if volatility goes up, that increases the value of all options. And finally here, rho, for interest rates, is a sensitivity of the value of the option to a change in interest rates. So if rates go up, what does that do to the value of the option? Well, if rates go up, it increases the value of call options. Incidentally, it also decreases the value of put options, but the specifics of that I am again going to leave to the derivatives material. So these are just the gammas, exactly what comes out of derivatives that show up and something that I would make sure I had a handle on. This is just a quick review. Okay, modifying risk exposure. So management can choose to do several things once they have identified a risk. They can accept it as it is. Okay? They can modify, they can avoid it. So that is, we're not going to participate in this because we don't like this risk. We don't think we're good at managing it. We can prevent it from occurring. We can transfer it, or we can shift a particular risk around the organization, okay, or to related entities, or to third parties, right? So to accept a risk is the same thing as saying self-insure. So if you have an automobile and you only have liability insurance on it, so you'll pay for someone else's automobile, the insurance will pay for someone else's automobile, then you're self-insuring for your own automobile. There's risk that you're going to, hit some black ice on the road, spin around, hit an oak tree, and it's going to mess up your car. And the insurance company is going to say, wow, that's too bad. Okay, but they're not going to help you pay for it because you only have insurance covering your liability for other cars that you damage. Well, you're a self-insurer for your car. So if you can bear that efficiently, that is, you are a really careful driver, you drive slow in bad conditions, you have a good driving record, then okay, you're accepting that risk, and you're fine with that, right? So if you're going to accept a risk, you are essentially self-insuring, and you may be intentionally exposing yourself to some risk because you have higher returns when you do. You can avoid a risk either by not engaging in the activity, okay, or you can, offload it to someone else. Preventing a risk would be along the same lines, and that is, okay, we're really sensitive to interest rate risk because we have high leverage ratios and we have variable return. We've issued floating rate notes. So if interest rates go up, our interest expense is going to go up, and our coverage ratios are going to go down, and we're going to be in technical default on our bonds and all that sort of stuff. Well, if we are really worried about that, we might prevent that risk simply by engaging in a derivative contract where if interest rates go up, we receive interest income, right? So some sort of a trade-off with some other firm out there in order to prevent the risk, or at least to compensate us in bad states of the world. So accept it, avoid it, or manage it. Maybe manage it to zero, maybe just moderate it. All of those would be options. So we want to modify risk exposure, again, transferring it to another party so we can buy insurance against it. Okay, either through an insurance company or effectively do it with a derivative. A surety bond, this is getting a third party, obligating a third party. You're in a position where someone is going to have to make a payment to you. You don't know or are dubious about their credit quality. Well, you can get a third party, i.e. their bank, to agree to pay. Well, if they don't, that would be a type of surety bond. And then a fidelity bond, we talk about bonding. This is in case employees do something dishonest. So if you are in the mortgage industry, you may have to be bonded in order to be able to handle escrow funds and those types of things. So in the event that you take off and head to Rio with someone else's money, then whoever it is that does the bonding would have to make whole whoever was supposed to receive those funds. So we can shift a risk, that is changing the distribution of outcomes, and again, we can do that primarily with derivative contracts if you're talking about a financial firm. Okay, so that is the idea behind risk management. Again, we talked a lot about the process and the idea of risk tolerance and risk budgeting, and once we've identified risks, what we can do with it at a very, very high level. This is not the reading where you want to get bogged down, but you do want to make sure you have a fundamental understanding that risk is not the probability that something bad is going to happen. Okay, in the financial world, risk is a two-tailed distribution where there's the risk of bad things happening and the risk of good things happening, downside risk and upside risk. So we want to expose ourselves to the risks that we're good at understanding and working with. And if there are other risks out there that we are not good at, well, those are the ones that we want to mitigate. So what we're trying to do here, in a sense, is optimize our portfolio of risks for the firm within this overall risk tolerance and with respect to the organization's goals.